What's going on, guys? Welcome to Stock Talk with Nico Kritikos. Today, we are going to do some stock analysis for Draftkings, ticker DKNG. This stock is a sports betting company, and today the stock is up a little bit over 2%. We're looking at a market cap of $11.5 billion. And if we go to the news today, we're going to see that DraftKings is trading higher because JP Morgan upgraded the stock to a price target of $37 now, up from 26. So that's quite a big jump from where it's at right now. So first thing let's look at is the revenue. Revenue growth has been very strong for this company, growing at an average of 63% per year for the last 5 years. Last year, they did $2.2 billion of revenue. Now, just for reference, I owned this stock at one point. I was an advocate of this company for a while. During the Cathie Wood era, I invested in a lot of her companies she talked about. This was one of them. And I want to say, I forgot if I want to say I never made money. I don't think I made money with it. I think what happened was it fell down, and she was buying and buying at like these prices of like $30 a share. And I think I saw it get close to like $20 a share or 25. And I started picking up shares. I bought all the way down probably to $15 or something like that. Then I ended up selling at about 18 or 19. So I ended up taking a loss. So I don't think I ever made money. Now, looking back, I think I sold in April. By April of this year, I was selling out. So by right around this time of about $19 a share. So really, it came up a lot from where it was at $11 a share. But really, if I would have held those shares for a couple more months, I would have made a lot more money. It went all the way up to $32. So I would have made a lot more money. But you can't change the past. So it is what it is. But the next thing on our list is going to be net income. And net income is not looking good. The trend is not good, and they've consistently lost money. They're doing negative $1.3 billion as of last year. So that's not good. I never like seeing that in my investments. Next thing we're going to look at is price to sales. How I said this company traded very high. This stock at one point was what, $72 a share. So it was, almost 3 times, let's say over two. This was like nearly a $30 billion company at one point. And this is with them never making a profit. So that's not good. But the price to sales has come down a lot since then. We're looking at, it's definitely kind of mellowed out here, and it seems to be trending along this 2 to 4 range. So I think this is in a much healthier spot now. I never like paying billions and billions of dollars for a company that is losing money, like 10 billion plus. That kind of, I don't know. That's taking quite a risk. If it's like $1 billion or something for a company and they're losing money, that's different. But some of these companies, like a lot of the Cathie Wood stocks, the last couple of years, they don't make any money, but they trade at least 10 billion, 20 billion, 30 billion, if not $40 billion valuations without making any money. So, and the stock price just keeps going down. So that's how I feel about that. The next thing is the innovation. Yes, the sports betting industry and the apps are definitely innovative, so that'll get a check. The market, this is one of the best things about this stock. I think this company also got a deal with ESPN. I want to say, I remember that like years back, if like probably over a year ago. I think they got a deal with ESPN. The market share is very strong. The reputation is strong. The image for this company, I think, is pretty good. So 32% market share is very strong. I think they have a good chance of being one of the dominant players, if not the most dominant player. Because when I was investing in the stock like 2021, 2022, it was the sports betting industry was still hot and it was still growing, but there was so many different competitors that there wasn't like, it was hard to tell who was going to stick around, because there was Wynn Resorts coming out with one, there was FanDuel, there was all these different companies making their own versions of it. And now I think it's still consolidating to where we should only see a couple main players in the space, but we haven't gotten there yet. But overall, I would say DraftKings is probably going to be in the top 3 or top 5. Return on invested capital is negative. Growing equity, no, it's actually down. This is another disappointing thing. Their equity it was negative in 2019, went to 2.6 billion during the pandemic. Now we're down to only 1 billion. So not good, not good. No, it's not over 15% of the market cap. Here's another bad thing about the stock is the share count. They keep diluting shareholders, and not by a small amount. The share count has gone from 184 million to now 436 million. So it's that's more than a double up just in the last 3 years, increasing at about 18, 19% per year. So I mean that's why the stock has gone down so much. I mean, at the same time, it's also recovered quite a bit from when it was, $10, $11. With it being close to 30 now, it has made a lot of progress, but still, this is not helping it. The balance sheet is not good. The margins are negative. Cash and receivables are small, but still more than the negative income. There's no dividend. The company is what, 11 years old? Yeah, 11 years old. And the free cash flow is bad, negative 1.3 billion last year, and it's still declining, as you can see here. So, I mean, I don't know. That's why I kind of learned my lesson with a lot of these Cathie Wood stocks, because she was buying all these companies that were maybe they were in innovative spaces, but they were money losing companies and the valuations were incredibly high. And that got even worse because Cathie Wood became famous for a lot of these stocks. Well, she became famous for Tesla, but then everyone looked at her other positions, and that's where, Draftkings, Roku, DocuSign, Block, PayPal, all these other companies that went to these crazy valuations, and then the stock fell. All those stocks fell like over, most of them fell over 70%. A lot of them fell 70, 80, if not 80%. PayPal was PayPal was a $300 stock and it fell all the way to 60. DraftKings went all the way up to $72 a share and then all the way down to 11. So a lot of these stocks just got killed. And I lost a lot of money with a lot of these companies. So I learned my lesson with that. And that's why I don't like buying stocks like this, because I don't want to overpay. I don't want to pay $11 billion or even $8 billion really for a company that's losing money. Now, I mean, this is a lot better of a situation because it could be, how I said, it could be a $30 billion company. Some of them, I think, like Zillow and I forgot the other ones, but the other ones she was buying, like Zillow, they were trading in tens. The valuation was tens of billions of dollars, and they weren't making any money. So that's just not healthy, and that's not a company I'd want to invest in. And then, how I said, if I was going to do that, it would have to be like a $1 billion, $2 billion company, maybe something like that. So that's how I feel about these stocks. But that's DraftKings for you. Thank you for watching, and I will see you guys in the next video.